Welcome to Accounting Modeling. In today's video, we are going to discuss about an important financial function. We call it the depreciation function. In your first year financial accounting course, under the topic PPE, the property, plant and equipment, you have extensively discussed about the depreciation. So here, what we are trying to do, we are going to looking at the computation of depreciation for a particular PP item using the inbuilt functions in your spreadsheet package. So we'll be looking at the computation of the depreciation under different methods using the inbuilt function that is available in your spreadsheet package. As far as this depreciation is concerned, the LKS 16 defines the depreciation as the systematic allocation of the depreciable amount of an asset over its useful life. As per the standard, it further says that when come to the depreciation methods, the depreciation method should reflect the pattern in which the future economic benefits are expected to be consumed by an organization. So there it says, when it comes to the depreciation method, the depreciation method should reflect the pattern in which an entity consumes the economic benefit of an asset, of an PP item. So accordingly, the LKS 16 does not prescribe a particular depreciation method. Instead, it may provide some description as to the different depreciation methods that is available. The only guideline that is provided on this depreciation method in the standard is, it says that the depreciation method should reflect the pattern in which the future economic benefits are expected to be consumed by an organization. Say for an example, so let's say that there is a particular machinery item. There is a particular machinery item in your organization. And when it comes to the economic benefit consumption, you may expect to do an equal output throughout the useful life of that particular machinery. If you expect to do an equal output throughout the useful life, then if you refer to the pattern in which that you consume the economic benefit, you would consume the economic benefit equally. Accordingly, as a reflection of that, the depreciation method, what you may use, should reflect that particular substance. Accordingly, your depreciation method should be something that gives you a depreciation figure which is equal throughout the useful life. And in simple words, we call it the straight line depreciation. It is called the straight line depreciation method. In contrast, let's take another example. Let's say that there's a particular machinery. As we took earlier, there's a particular machinery item, and you expect that the useful life of this particular machinery is 5 years. When it comes to the consumption of economic benefits, you may expect to do the higher number of units from that particular machinery in the initial periods of that asset. And when the asset ages, you may expect to do a lesser number of units. Say for an example, so we agreed that the useful life of this particular machinery is 5 years. Let's say in the first year, you may expect to do 20,000 output. Then the second year, you may expect 15,000 units. The third year, say 10,000 units. Fourth year, maybe 8,000 units. And in the fifth year, you would expect only 5,000 units. Then if you refer to the pattern in which you consume the economic benefit, you can see that you are expecting to take a higher benefit at the initial stage of that particular asset. So you are expected to do 20,000 units in the first year of operation. Then in contrast, when it comes to the year 5, you would expect only 5,000 output. So you can see throughout the period, the economic benefit consumption has reduced. So when the asset ages, the benefits what you may take, the expected benefit is reducing. So therefore, when it comes to the depreciation method, what you may select should reflect the particular substance. So in that, you may have to use a depreciation method which would give a higher depreciation at the initial periods of the asset and lower depreciation towards the end of the useful life of that particular asset. So in a sense, that is going to be a declining balance depreciation method. Under a declining balance depreciation method, what happens is you would be calculating a higher depreciation in the initial stage of the useful life of a particular asset, while you'll be calculating a lower depreciation figure towards the end of the useful life of a particular PP item. So therefore, in that particular scenario, the declining balance depreciation method would reflect the pattern in which you may consume the economic benefits. So likewise, the LKS 16 may provide guidelines as to the selection of depreciation method. So what it dictates, it says that the depreciation method should reflect the pattern in which the economic benefits are consumed from a particular PP item. Let's now move on to the discussion of depreciation methods. The Excel financial function allows you to do depreciation calculation using spreadsheet very easily. So when it comes to the computation of depreciation using the inbuilt functions in your spreadsheet package, it's going to be a really easy task. So as you experienced in the previous financial functions, so here also you would find that, so the computation of depreciation, it would be a quite easy task. There are different depreciation methods. So in this Excel spreadsheet package, there are different inbuilt functions that would help to compute depreciation under different methods. Out of that, we are going to discuss about most commonly used depreciation methods by a business organization. So under this, we expect to discuss about the straight line depreciation method, the fixed declining balance method. So it's a declining balance depreciation method, and another variation of declining balance method, we call it double declining balance method. And finally, another declining balance depreciation method, we call it sum of the years digit method. So in the first one, you would experience the straight line, the equal amount of depreciation, while the rest of the three methods may provide you a higher depreciation in the initial age of the asset, while towards the end of the latter part of the useful life of the asset, you may experience a lower depreciation amount. Let's now move on to the straight line method. In the straight line depreciation method, the depreciable cost of the plant being spared equally over the period, making up its estimated useful life. So we call it under the straight line depreciation method. So you would spread the depreciable amount of a particular asset equally throughout the useful life of that particular asset. The abbreviation of this formula is SLN. So the inbuilt function what serves the straight line depreciation, we call it SLN. This formula returns the straight line depreciation of an asset for one period. So it will compute the depreciation. So in fact, so when it comes to the straight line depreciation method, throughout the useful life, a same amount of depreciation would be applicable. So if you look at the syntax of the formula, you can see the cost must be an important input. You need to identify the cost of an asset. Then the salvage, so it is the residual value, we call it. So another term, we call it salvage value, and the life. So life in the sense, the useful life. So you have to feed these three information, then it would return the depreciation for a particular asset. So let's move on to the exercise and let's see how to compute the depreciation under the straight line method. Assume a company purchased an equipment which cost rupees 100,000 today with residual value of 10,000 and useful life of 10 years. Use the straight line method to depreciate this asset. And thereafter you've been asked to prepare the depreciation schedule as well. So now let's take this question to the Excel sheet and see how to work this out. So it's a pretty simple scenario, but we may see how to work this out. Right. So as usual, so we are into the model development. So we need to identify the inputs for the depreciation computation. So here we have the important inputs of the cost information should be there. The question says that the cost is 100,000. So we have taken the cost 100,000. Then we have the residual value or the salvage. The salvage value, there you are given as 10,000. The salvage value is 10,000. And the useful life is also given, that is to be 10. The useful life. So this would be the most important inputs that would require to compute the depreciation under the straight line method. Now let's compute the depreciation. So we are going to compute the annual depreciation. So you can use the formula, that is SLN. SLN. Then you can take the expanded form of the formula. Then here you can input the information. The cost is there. You may refer that. The salvage, the residual value is 10,000. The life, it is 10. So here it gives you the depreciation per annum, that is 9,000. So you can format the currency. So we may take that to the LKR, Sri Lankan rupees. Right. So the annual depreciation we have compute, that is to be 9,000. Then you've been asked to prepare the depreciation schedule for the total life period of the asset and prepare a bar chart to show the depreciation expenses and accumulated depreciation throughout the life of the asset. Okay, now let's move on to the preparation of depreciation schedule. So as we did in the case of loan amortization schedule as well, so we may start with the period. So here we can start with the period. That is one of the important information. Then you need to know, since it's a depreciation schedule, you need to know the depreciation per annum. Then you need to have the accumulated depreciation as well. So you may get the accumulated depreciation. Before these two information, in fact, you should have taken the cost information as well. That is an important ingredient that I had missed earlier. So I might take that, the cost, the period cost, the depreciation and accumulated depreciation, and finally we may get into the carrying amount. So this would be the most important information, that is for the preparation of the depreciation schedule. So here we call it the depreciation schedule. So let's get the period. So the period goes from year 1 to 10. So you can take year 1 and 2, then you can simply drag this down up until year 10. Then you can identify the cost information. So here you can make a reference. It's 100,000. So make it constant. Then you can drag them down so it may remain constant throughout the period. So the cost information may not going to be changed. So this is for a particular equipment item that we are constructing this. Then the depreciation. So the depreciation also, it's not going to change. So earlier you have compute that, even you can make reference from there, but here let me compute that one more time. It's under the straight line method. You get the cost, make it constant, then the salvage, you can keep it constant, and the life, so it's going to be 10 years, so you can make it constant. Say okay, then you can drag them down. You can format the currencies if required. So let me put that to the LKR. then you can get the accumulated depreciation. So at the end of the first year, it is go to the depreciation and thereby the carrying amount. You can simply take cost minus the accumulated depreciation would give you the carrying amount. Then when it comes to the second year, the accumulated depreciation is going to be the accumulated depreciation in the previous period plus the depreciation for the relevant period. So it's 18,000. Then you may simply take them down. Then the carrying amount, you would do the same. So once you click on that, you can see it spreads throughout the period, and you can see at the end of the useful life, the carrying amount has become equal to the residual value. So your residual value was 10,000. You can see at the end of the useful life, so this has become equal to the residual value. So here you can format the carrying amount as well. So currency format. Even the cost. So we may format that. Right, this is what we call the depreciation schedule. So there you have identified the cost, the depreciation, accumulated depreciation, thereby the carrying amount. So under the straight line depreciation method, the most significant feature what we have observed is the depreciation is equal throughout the period. The annual depreciation is equal throughout the period. Now what we may do, we may take a bar chart to show the depreciation expense and accumulated depreciation throughout the period. To have a sound representation of this depreciation and accumulated depreciation, so you can take this to a bar chart. So you can take it for a graphical representation, then it would be more convincing for the audience. So we may take that, you can go to the insert and you would take a bar chart, a suitable one. So you can select from the insert, the charts are there. From that, you can select a more suitable one. So this particular kind of chart, I think you can increase the size of this, and here you can see the title can be changed. So this is the depreciation. Of PPE, say, right, you can see here the depreciation is denoted in the blue color, while the accumulated depreciation, it is represented in the orange color. So this is what the graphical representation of the depreciation, and there you can see clearly. So the depreciation per annum is equal and the accumulated depreciation is increasing in a constant rate. In a constant rate, the accumulated depreciation is increasing. Then, more remarkably, you can see at the end of the useful life, this depreciation, the accumulated depreciation has become 90,000, thereby the carrying amount had become 10,000. The carrying amount had become 10,000, which is exactly equal to the salvage value. So here's the basic representation of the depreciation and accumulated depreciation. And this is how the straight line method works. Now we may go and explore another depreciation method. We call it the fixed declining balance method. So it's a declining balance depreciation. Declining balance depreciation. We'll see what it is. It returns the depreciation of an asset for a specified period using the fixed declining balance method. So it would give you the depreciation under the declining balance method. So here we use the abbreviation, as in the case of straight line method. Here we have the abbreviation, that is DB. The fixed declining balance method compute the depreciation at a fixed rate. So here under the declining balance method, the depreciation is computed in a fixed rate, and that's why we call it the fixed declining balance method. However, the depreciation what you may experience throughout the useful life, you would see at the initial stage of the useful life of the asset, you would see a higher depreciation, whereas towards the end of the useful life of the asset, you would witness a lower depreciation, comparatively low depreciation. So we may witness that in a while. The declining balance uses the following formula to calculate depreciation for a period. Under the declining balance, how the depreciation is computed? It is simply the cost minus the accumulated depreciation multiplied by the rate. So we agreed that the rate is a fixed one, and in order to see what is the applicable rate, you can use this following formula to compute the rate. So here it is given, the rate equals the 1 minus the salvage value divided by cost to the power 1 divided by the useful life, and that is going to be the rate, and that particular rate is going to be constant throughout the period, and it is rounded to 3 decimal places. Basically, this is what happens over there. You need not to consider about these aspects if you are dealing with the inbuilt function. So it is automatically taken care, but this is just to show what is behind this. So this would be the formulas, functions that is behind the declining balance method. But you may need not to learn these aspects. So the expectation is to compute the depreciation using the particular depreciation method. So that is what we expect from you. But just to give you some theoretical underpinning, we are providing this information. The depreciation for the first and last year is a special case. So this is in fact the case when it comes to a kind of acquisition of the asset in the middle of a particular year, not at the beginning of the period. So when it comes to the practical scenario, that we are not going to acquire a particular asset at the very first day of a particular reporting period. So if we acquire a particular asset from the very beginning of a particular reporting period, you need not to consider about these months. But if you acquire that in the middle or somewhere within the financial year, so in that particular case, you may have to consider about this month aspect. So you have to time apportion that, So here we'll be looking at that as well. So having discussed the basic formula, we'll be looking at an instance where you acquire an asset in the middle of a particular year. So that's why we call it the depreciation for the first and last year is a special case. That is only the case if we acquire it in the middle or in between the reporting period, right? So that's why it is discussed over here. So let's move on to the syntax. So the syntax what we use here, it is called the DB, as we agreed. There we have to identify important inputs. The first three inputs you are familiar. The cost has to be there. The residual value, we call it the salvage, and the life. The life stands for the useful life. Then you have the period. That is a difference from the straight line method. Under the straight line method, we didn't have something called period. But here, we have necessarily this period, right? Why it is there? Because I told you that when it comes to this particular depreciation method, the depreciation would vary from year to year. From the initial periods, you would experience higher depreciation, whereas you would experience a lower depreciation towards the end of the useful life of a particular asset. So therefore, the period is an important element in this declining balance method. Then also I have referred you may have to refer to month in special cases. The special case in the sense, in some instances you may acquire that particular asset in the middle of the asset, not at the beginning. So if you acquire that somewhere within the financial year or the reporting period, then you may have to refer for this month. Say that your reporting period begins on 1st of April and you acquire a particular item of PPE on 1st of July. If that is the case, in the first year, the depreciation has to be done for a period of 9 months only. You have to time apportion that. In that particular case, you have to indicate that the number of months left in the first year. It has to be indicated. And that's what we call the month. That's what we call the month. If we omit this, it normally takes as 12. It normally takes as 12. So we may work out this through an example, then the things would be more convinced. Assume we purchase an equipment which cost 100,000, residual value 10,000 and the useful life 10 years. So you can use the same set of information earlier and work out the depreciation. And also you've been asked to prepare the depreciation schedule and also the graphical representation. So we may use the previous information and we would work the things out. Here we have done the straight line depreciation method. Now we may move to, so I would mention somewhere over here, the first method what we did, the straight line depreciation. Then we are moving on to the declining balance method. So more specifically, the fixed declining balance method. So under this, we may identify the depreciation schedule. Here also we may use the same set of information. So therefore, you can take the period, goes up until 10 years. The cost information can be taken from the previous inputs. We may refer to the same inputs, make it constant. You can drag it throughout the period. Then the depreciation. Now we are coming to an important point. Let's see how to compute the depreciation. You can take the function that is db. So you can double click and you can expand it. Then we may input the information. So there it asks us what is the cost. So you may refer to the cost information. Salvage value is asked. It's 10,000. You may refer to that as well. Then the life, that is also something constant. You may refer to that. So the life is constant. And more importantly, the period. When it comes to the period, you would have to refer to the period in the depreciation schedule. So the period is 1. So you have to keep it relative since we drag them down. Since we drag them down, you have to keep it relative. The month, we are going to ignore that. Here our assumption is we will be acquiring the PP item at the beginning of the year. So therefore, we are going to simply ignore this month information. Right? Say, okay. So now you may drag them down. So here it computes the depreciation throughout the useful life of the asset. Then you may take the accumulated depreciation as well. The first year, no problem. The depreciation is the case. Cost is 100,000. Accumulated depreciation is deducted. And you may drag them down. So here you can take the previous year accumulated depreciation plus the depreciation for the relevant period would do the accumulated depreciation. Then you can simply drag it. And here it gives you the depreciation and accumulated depreciation, thereby the carrying amount. So here you would witness a kind of thing that when come to the end of the useful life, the carrying amount is supposed to be 10,000. But it is little different from the carrying amount what we may have. The carrying amount is 9,958, whereas the salvage is 10,000. So this is something you can pretty expect under this declining balance method. It is simply because the rounding what we may use over here. The rounding what we may use over here. So that particular kind of small difference can be expected. So it's pretty negligible, 9,958.75 versus 10,000. Or simply you can adjust it through the depreciation. So you may adjust that through the depreciation, thereby the carrying amount would become equal to 10,000. So therefore a small adjustment you may have to do under this depreciation method for the final year depreciation. So it is something that you can expect. So it's a simple adjustment. If you see that the salvage value is 10,000, all you have is 9,958.75. So the difference is 41.25. So it's due to the rounding. Here we discussed that. So we would be rounding the rate into 3 decimal places because of that. So small differences could be witnessed. So in order to overcome that, what you can do is you can decrease the depreciation by this 41.25. Then this may become 10,000. Let's see. You may go to the final year depreciation and you may adjust them over there. 41.25. See, the carrying amount has now become 10,000. Has now become 10,000. So you have adjusted the rounding error in the final year depreciation. And that's how you may do it. Even you do not do that, it's not a big issue. It's not a big problem, but so it is for the sake of perfection, we may do that. Now we can format this. It's a kind of currency formatting. Go to the more numbers, and it is going to be LKR. Right. Here we have the depreciation schedule under the fixed declining balance method. Fixed declining balance method. Then similarly, if you are to take the graphical representation, yes, you can do that. So you may select the depreciation and accumulated depreciation. You can go to the insert, then the chart. You can select a suitable chart, and here it is. Now you can have a strong representation. So this is more convincing. You can see, if you clearly see this, in the initial period the depreciation is higher, but when the asset ages the depreciation is reducing. So this is what I was highlighting. So this is the pattern in which we may consume the economic benefit of that particular asset, and this depreciation would reflect the pattern in which we may consume the economic benefit. So when the asset ages, our economic benefit consumption is getting reduced. In the initial years, it's going to be 20,600, whereas in the final year, it is 2,542.5. So you can see it's the considerable reduction is witnessed throughout the life of the asset, throughout the useful life of the asset. So here we call it the depreciation of PPE. Under the declining balance method. Earlier also I may mention that it is under the straight line method. Straight line method. So it is denoted by SLN. So here, so I would like to take you through one important thing, that we agree that when it comes to this depreciation, so we'll be using a constant rate, and how that particular rate is computed, that was given in the Excel, given in the presentation. We may go and take that particular kind of rate computation, and let's apply this to this question and see whether that is the case. It says that the rate is computed as the 1 minus salvage value divided by cost to the power 1 divided by life. So we may copy this and we'll try to apply this in the question, and try to compute depreciation manually for 1 or 2 years. Then we can ensure ourselves the depreciation what we have calculated is pretty correct. Then you may move on to the computation. It says that it has to be the 1 minus the salvage. So it's going to be 10,000 in this question. As we witnessed, the cost was 100,000. So we may take that, and you can take that is to the power 1 divided by the useful life. 1 divided by the useful life. It was found to be 10 years. 10 years. So this was the case, right? It gives us the rate of 0.205, and further it was said that we need to round this to the 3 decimal places. Now we may round it, right? Once you round it to the 3 decimal places, you can see that it is 0.206. So accordingly, if you apply this and do the depreciation, you must get the same amount. For example, let's try this for the first year. So when applying the declining balance method, you apply that to the carrying amount. So however, in the first year, no accumulated depreciation is there. When you get the carrying amount, you can simply take the cost and take it. So the cost is 100,000, as you can see. It is 100,000 multiplied by 206. So you can see that there it comes as 20,000 567. Let's round it even and let's see. It has to be kind of something wrong with the number. Yeah. So it hasn't considered this rounding, though we have rounded that, it was not applicable. So let's take it out and multiply that. No, so it's obviously 20,600 has to be there. Since we know this rate, now we may take it like 0.206, and yes, you can see that's what gives you the depreciation for the first year. Then similarly, if you try this for the second year, you can see that the second year you have to take the carrying amount, the cost minus the depreciation. So when you come to the second year, at the beginning of the period, the carrying amount is going to be 79,400. The carrying amount at the end of the first year is the carrying amount at the beginning of the second year. So it is 79,400 carrying amount. The depreciation rate is 0.206, and if you apply that, you may ended up getting the depreciation for the second year 16,356, and it coincides to the depreciation that had been derived under the formula declining balance method. So that's how we do. So it confirms we have done this correctly. Now we'll be exploring another important aspect. It's about the acquisition of this particular asset at the middle of a particular reporting period. So let's take that particular instance and let's work and question for that. Then it would be convinced how to explore that particular input as well. So let's say that you have a particular asset, say a particular item of property, something. So let's say it's a building. You have a building with a value of say 5 million. You have a building with a value of 5 million. You are acquiring that on 1st of July 2020. 1st of July 2020, you may acquire that. And your reporting period is the acquisition date, the date you acquire it. And your reporting period begins on say 1st of April 2020, right? Okay, so this is the information what you may have, and you decide the residual value or the salvage. So it's found to be say 500,000, the residual value. Then you have the useful life. Let's say that you expect to use it for a period of 10 years. Then when you get the period, you can start with 1, 2, and here, since you are acquiring it in the middle of the year, definitely you may have to go for the 11th year as well. So since you purchase it on 1st of July 2020, even in the 11th year, you may have to go for another 3 months. Another 3 months. No? So this year completes 2021 30th July. So likewise it goes on. So therefore you may have to go for the 11th year as well. 11th year as well, right? So accordingly, so we may take the period as 11 years. In the last year, you may have to go take depreciation for 3 months. The cost information, you can simply get them and make it constant. The depreciation, so how do you compute? That is called TB, fixed declining balance. The cost information can be taken as 5 million. The salvage value or the residual value, it is 500,000. The life is there, that is 10 years. The period, you may refer to 1. And now we are coming to the most important point, that's about the depreciation for the first year. So when it comes to depreciation, here it says that the first year and the last year is quite special. Why is that? Because in the first year you need to depreciate this for not for the 12 months but for the 9 months. 9 months, because your reporting period begins on 1st of April, so consequently it ends on 31st March. So therefore from the acquisition date to the reporting date, you have 9 months in the first year. So therefore you have to feed the month as 9 over here. It should be 9 months. So you may input that information, say 9. So if it was 12, you could have simply ignored that. Then you can see the depreciation comes as 1,030,000. But since it is 9, you can see a lesser amount of depreciation is identified. Say OK. Now you can simply drag this depreciation. It is taken throughout the period. And here you simply let that 9 months to be there. Then when it comes to the final year, the depreciation, the system would recognize and they would do the depreciation only for a period of 3 months. Only for a period of 3 months the depreciation is done. So that may be, if you acquire this on 2020 July 1st, it may be go up to, if it is 10 years, 2030, 30th June 2030. So therefore you may have to do the depreciation from 1st of April 2029 to 30th June 2030. Sorry, it has to be 1st of July 2030 to 30th June 2030. So this would be the remaining 3 months. So in order to complete the 10th year, right? So in that particular case, you may have to consider this depreciation even in the 11th year. 11th year, you may have to consider that. Okay, so this is the most important thing what I wanted to show you. So the only thing what you did, you simply go and mention how many months to be depreciated in the first year. That's it. Then you simply let them there and you simply drag it. So thereafter you need not to do the changes subsequently. That's it. Then when it comes to the final year, automatically it identifies. So we may have to do the depreciation for another 3 months and the depreciation would be done, right? Okay. So we can complete this. The accumulated depreciation is taken the carrying amount is can be taken thereby. This is it. The second year accumulated depreciation, the accumulated depreciation in the previous year plus the current year depreciation, you can take it, drag them, and here also you can take this cost information down. It does not change the carrying amount as well. Right, again, due to the rounding errors, you can see a small difference of 2927.60 comes over there. Then in order to avoid that, what you can do in the final year, you can do a manual adjustment. So if you increase the depreciation, then the carrying amount would be reduced. You can increase it by 2927.6. So with that, the depreciation become 500,000. You can select the entire period. So the cost, depreciation, accumulated depreciation, and carrying amount, thereby do the formatting. So it's about the currency, it's LKR. Say okay. Right. So this should be the depreciation, and that is how you time apportion the depreciation under the declining balance method. So this is one of the commonly used depreciation method. So this is how you time apportion the depreciation. But however, you have witnessed that in the straight line method, that particular option was not there. But it may be simply because it's quite obvious. So if you do the depreciation, the time apportioning is not a big issue in the straight line method. So if you had acquired this asset 6 months after the reporting reporting period begins, then in the first year, you know, you have to depreciate only 6 month time. So therefore, having taken this standard depreciation, you can simply time apportion that. Then you would get the relevant depreciation. Then consequently, you may recognize the 11th year and you may take the time apportioning there as well, and then you may simply complete that. So therefore, time apportioning under the straight line method is not a significant thing. So that would have been the reason why the time apportioning was not introduced to the SLN function. However, here we have witnessed the fixed declining balance method. It is little uh, comprehensive and little complicated. So especially when it comes to generation of this rate as well. So therefore, having considered this complexity, so they would have introduced the time apportioning to the particular function. So that could have been the reason, right? Okay. So now let's move on to the double declining balance depreciation method. This is also another variation of declining balance method. So earlier we discussed about the fixed declining balance method. Now we are going to discuss about the double declining balance method. What is that? It says that the double declining balance method return the depreciation of an asset for a specified period using the double declining balance method or some other method you specify. So here by default it takes the double the value of depreciation, or if you want to change it, say that you want to make it 3 times, you can make it 3 times, or if it is 4 times, you can make it 4 times. We'll see what it is. The abbreviation of this formula is double declining balance. It is denoted by DDB. The double declining balance method compute depreciation at an accelerated rate. So here, compared to the straight line method, here you would see the depreciation is taken at double the rate. So for an example, when you take a particular scenario, by referring to the cost information and the residual value and the useful life information, you would be able to figure out what is the straight line depreciation rate. So you may get into a particular figure. Under the double declining balance method, what is going to happen is the rate is going to get double. Say for an example, so if you compute the rate under the straight line method for a particular scenario, let's say it is 10%, then under the double declining balance method, what happens is that that rate is going to be doubled and the depreciation rate is going to be 20%. If you want to make it 3 times, so it's going to be 30%. Likewise, the depreciation is highest in the first period and decreases in successive period. Here also you would experience what is common for the declining balance method. So higher depreciation in the first periods and lower depreciation towards the end. So the same thing you would witness under the double declining balance method as well. Now we may see the syntax for this double declining balance method. So all the information what you used to had under the fixed declining balance method is also here. So what is new? It is going to be the factor. So when it comes to the factor, it is called the rate at which the balances decline. So by default, that is in the sense if you omit this, it is taken as 2. So this would be further explained when it comes to the question. So if you ignore that, it is by default taken as 2. Then if you want to make it 3 times, you can take 3, or 4 times, make it 4. Likewise, you can change this factor. So this is simply the you may have a particular rate for a particular scenario, the depreciation scenario under a straight line method, and that particular rate would be doubled when you come to the double declining balance method. So that is what going to happen, right? So we may work out the question and then we may explore this further. You are given the same information, so as previous, then we can make we can draw from the previous similar information, similar inputs, and we can work out a question. So we may go and see. So here also you need to have the information. The schedule needs to be developed. So it is the double declining balance method. The period goes as usual. We are assuming 10-year period. So we may take it. And the cost information, you can simply take that from the inputs that we have originally and make it constant. Since we are going to drag it, you can drag it. Then the depreciation, this is the most important thing, and we may do this using the formula, the inbuilt formula, that is DDB, double declining balance. So here you need to input the cost, so you can take it. Then the salvage, you may take it, and the life, so those information you are quite used to. Then the period, so the period is going to be a relative cell, and you may refer to the period because the depreciation is going to get changed from period to period. The factor, so you are simply going to ignore this in this particular instance, and we may simply go by that, and later we may further explore that. Then at the moment, what you know, if you ignore this, it is assumed to be 2, right? Okay, say okay. Now you can simply take this down and see. So this is it. So it was explained that in the first period the depreciation is higher, then in the subsequent period you can see the gradually depreciation decreases. Then the accumulated depreciation, you can take it the first year the same amount, but the second year onwards the last year depreciation plus the current year depreciation, So you can take them down, and thereby the carrying amount can be located. So it is 80,000. You can simply take this down. So again, the rounding difference comes. You can easily adjust them over here. 10,737.42. If you add more depreciation of like 737.42, and it's going to be exactly 10,000. Now you can even format this currency. That is clear, right? Okay, so this is what the depreciation. Now I believe that we need to further investigate what do you mean by this double decline in balance method, right? We'll see. I told you that when you take a particular information, let me take the same set of information what you have made use of, right? If I ask you by referring to this particular scenario, say you have acquired an item with a cost of 100,000, salvage is 10,000, useful life is 10. If I ask you to figure out what is the straight line depreciation rate over here, straight line depreciation, straight line depreciation, how much is that straight line depreciation rate? If I ask you to figure out, how do you do that? You know, under the straight line method, the depreciation is taken like equally. So therefore, if the useful life is 10, then each year depreciation is going to be 1/10. 1/10. So consequently, depreciation is 10%. Then under the double decline imbalance method, what is going to happen is this straight line depreciation method, straight line depreciation rate is going to get doubled. And that's why we call it double decline imbalance method, right? So you can take this 10%, if you multiply it by 2, you know it is 20%, right? So this is the double declining balance. Double declining balance, double declining balance depreciation rate. So as the term suggests, it is simply double the straight line depreciation rate. Then how do you ensure ourselves? So let's go and do the depreciation in the first year and see by applying this rate. Under the declining balance method, you know how to do the depreciation. It is simply the carrying amount multiplied by the depreciation rate. But in the first year, the carrying amount is going to be equal to the cost since there is no depreciation from the beginning. So you may take 100,000 and you may apply this 20%. See, the first year depreciation has to be 20,000. Is that the case? If you go there, yes, it is 20,000. Then the second year, how much should be the depreciation? Always the carrying amount into the depreciation rate. How much is the carrying amount? The cost, you have 100,000. In the first year, you can see the accumulated depreciation 20,000. And if you multiply this by the rate 20%, this is it, 16,000. And similarly, the third year, just to verify yourself, you can see the depreciation, accumulated depreciation, cost is 100,000, accumulated depreciation 36,000 at the end of the second year into the rate, and that must be 12,800. So therefore that is perfectly fine. Now it confirms the double declining balance would double the rate that you use in the straight line method. Say that you want to make the rate 3 times higher compared to the straight line method, then what you need to do? Then the rate what you want is 30%, no? What you can do is, and that is where this factor become applicable. You can go to the factor and make it 3. By default, it is taken as 2. If you want to make it 3, make it 3 and see. it becomes 30,000. Depreciation becomes 30,000. If it is 4, 40,000. If it is 1, 10,000. Then it is equal, the rate is equal to the straight line rate. But by default, it takes 2, right? And that is how we use the DDB, and that is the application of this factor. By default, it is 2. It will double the straight line method depreciation rate. If you want to make it 3 times, make it 3, 4 times 4. And if you want to keep it 1 time, make it 1. If you omit, it is just double it, right? So it is the explanation as to the double declining method. So here also we may take a graphical representation. You can go to the insert, the functions, sorry, the charts. Take the same chart what we used to have, and here it is. Again, since it's a declining balance method, so it would reflect something that is similar in fashion to the fixed declining balance method. When the asset ages, the depreciation reduces. So here we call it, so you can so it's a depreciation of PPE under the double declining balance. Double declining balance. So this is it. Now let's move on to the final depreciation method. We call it the sum of the year digit method. Again, I would say this is also a variation in the declining balance method. So here also you would experience the same reality. So there would be higher depreciation uh, at the start of the useful life, so towards the beginning of the useful life. So however the asset ages, the depreciation what you may get is going to be a lower depreciation, comparatively lower depreciation you would experience. This return the sum of the year's digit depreciation of an asset for a specified period. The abbreviation of this formula is SYD, sum of year digit. Here also the some of the information that you are familiar, the cost, salvage and the life information you are familiar. Then the period is known as PER over here, PER. So it's going to be the period. So again here what you would witness that the depreciation would vary from year to year. Here it written the sum of the year's digit depreciation is what's going to get returned. So accordingly the depreciation would vary from year to year, right? So we would witness that, and we even see how it may work even in a manual setting. Right. We have taken the same example and we may go and work this out. Structure. So it's going to be the sum of year digit method. Sum of year digit method. So the periods, as usual, it goes from period 1 to 10. The cost information you can take it from the input data. It's 100,000, make it constant since you are going to drag it throughout the period. Then the depreciation, now we are coming to the important point. Here we use SYD. So the cost information you can take it 100,000. The salvage, there you have it, 10,000. The life, 10. Then most importantly the period. So period runs from period 1 to 10. So you keep it relative because you need to drag this depreciation, then you need to see the different depreciation for the period. So you can see it's 16,363.64 in the first year, and the subsequent years you can get it like this. Since it's a variation of the declining balance, so here you would witness that the depreciation is higher in the initial period of the useful life. Towards the end, you would be witnessing a lower depreciation. A lower depreciation rate would be witnessed. Here you can take the accumulated depreciation as well. It's depreciation in the first year. The second year, it is the previous year accumulated depreciation plus the current year depreciation. You may drag it down. Then the carrying amount, the cost minus the accumulated depreciation must be there. So you can drag it, and you can see at the end the carrying amount had become equal to the residual value. Then if you are to witness how this operates in a manual setting, what you have to do, first you have to take the total of the years. Total of the years has to be taken, right? Then if you get it, this is how we manually do this. You can take the total of the period, then it comes as 55. Then as the term suggests, the sum of the year digit is what the depreciation should be. When it comes to the first year depreciation, it should be the last year's digit divided by the total digit. So therefore, if you get it over here, it is simply the 10 divided by, so the format, let me change it here, get into the number format. Its last year digit is 10, that is divided by 55 is what going to be the depreciation percentage. So here if you get the depreciation percentage, it's like 18.18. So consequently, how you compute the depreciation? So it's going to be here, remember that you are taking the depreciation computation goes like this. You would get the cost information minus the salvage value. Unlike in the previous two instances, here you have to take it like cost minus the salvage value, and that's what you may depreciate using the rate applicable for the period. It's going to be multiplied by 18.88 for the first year. So it comes 16,363.64. Then for the second year, the rate should be the 9th year depreciation, since for the first year you have taken 10th year. Consequently, for the second year, you would take 9 out of 55. It's a rate, and that is into the depreciable amount. So the depreciable amount is going to be, it's always cost 100,000 minus 10,000. So you can multiply them by the rate. So it comes as 14,727.27. So this is going to be the depreciation rate, the applicable rate. So how it is derived? So you're going to derive that depreciation rate. It is simply the sum of the year digit. So you're going to get the digit, so in the reverse order. So therefore, when you get the reverse order, it's going to be like starting from 10, and it may go 9 likewise, right? Let's see whether it works. Drag it. No, it's not going to work. It's in the increasing pattern. So it's 8, 7, 6, 5, 4, 3, 2, 1. So this is what the year's digit in the reverse order. So when it comes to the depreciation, you may take the total. So it is, the rate is simply the years digit in the reverse order divided by the total or the sum of the years digit. So consequently, the first year you have taken like 10 divided by, it is G76, 76 here, it's 55, and the next one, so the same thing. So here the 55 is applicable. 10 out of 55 is the first year depreciation. In the subsequent years it goes like this. In the final year, 1 out of 15 depreciation is taken. So if you simply drag this, you can see the depreciation that is applicable throughout the period. And if you drag this, so you would see the depreciation, how it had been taken. It corresponds to the depreciation. So here we wanted to give you a kind of explanation how this is done even in a manual setting, but that is not the most important thing. You need to know how to do the depreciation using this particular function, but still the theoretical aspect is important, so we went on elaborating that. Right now you know how this depreciation had been derived. Now you can select this and take the graphical representation as usual. You can put it to this. So here it comes the depreciation representation. So this would be the depreciation of PPE under sum of year digit method. Sum of year digit method is finding. So this is how we get the depreciation. So here you can see at the initial period the higher depreciation would be there, but the asset ages a lower depreciation would be taken. So that's why we agree it's a declining balance depreciation method. So one of the declining balance depreciation method. Okay, now what I thought of, we may compare all the depreciation that we had compute under the different methods throughout the period. We may consider the depreciation that we had done using the different method. So let's take a comparison and see, then you can see how this depreciation varies from different methods under across the different methods. So you can take the period, it goes from 1 to so up until the 10, you may have it. So the first we used to take the straight line method, SLN, it is denoted by SLN. Then the second method was DB, the third method is DDB, and final method SYT. Now we may take the depreciation that we had taken under each, starting from the depreciation from sum of year digit method. So you can keep it and make sure to paste only the values. No, so you have learned the paste is special, so make sure to take the values, and that is what important for us. And the DDB, similarly, make sure to take the depreciation but the values only, you may paste. So let's keep it 2 decimal places. The double declining balance method, then we have the fixed declining balance method depreciation as well. Sorry, this was the same thing that, so here we have it, the fixed declining balance method depreciation. It's the DB, make sure to take the values only. straight line method. So we have taken that. Okay, now we have everything. Now we may take a comparison. So let's take it to a bar chart and see. Right, now you have a kind of good comparison over here. So you can expand that table and see. So this is how the depreciation had been. So out of the different method, you can see that under the decline in balance method, the greatest depreciation was witnessed in the first year. So throughout the useful life, in the first year, the highest depreciation was witnessed under the decline in balance method, whereas the lower depreciation was witnessed under the straight line method. In fact, under the straight line method, you can see an equal depreciation. Then if you go to the last year, you can see that the lowest depreciation was witnessed under the sum of year digit method. Sum of year digit method, the lowest depreciation was witnessed, then the highest depreciation was the straight line method. And this will show how this depreciation has changed throughout the period, and also it gives you a good comparison across the different depreciation method. It gives you the comparison across the different depreciation methods. So it's what a more graphical representation. Now you can see how each of these depreciation methods works. So it's a comparison of depreciation. So under the reduce imbalance methods, you can see that the depreciation is constantly reducing. That is another important observation you make here. If you take this decline imbalance, you can see that you start with somewhere in, so to be exact, 20,600. Then you can see that it gradually decreases. Then at the end, it is 2,542. Then if you go to the double decline imbalance, so it is doubled. First year 20,000, then it gradually decreases, then in the final year it had become 3,421. So it's a gradual decrease is there. The sum of year digit method, the same observation is there. You start with the higher number 16,363, then you may comes down to the lowest figure of 1,636. However, in the straight line method, you can see the equal amount of depreciation has witnessed throughout the period. So it's about the comparison of depreciation. Comparison of depreciation. Fine. So with note, we can finish the discussion on depreciation. Thank you.